Hey, Dustin Tibbetts with Passport to Wall Street, and today is our trade of the week. We're going to do something actually pretty unique today, so we may use the whiteboard to explain it. Well, there are a lot of volatile stocks in the market today, and there's actually a lot of different volatile sectors. One sector that many people are starting to talk about as maybe being discounted and an opportunity for more of a long-term investment is the home builders. So if you've seen the home builders, boy, they are struggling. So they're down over 20% year to date, higher costs. They have higher labor costs, higher material costs. Obviously, interest rates here are going higher, and so it's starting to push off the home buyer. So there's a little bit of weakness going on in that sector. However, with weakness comes a discount, and sometimes people like to look for those discounts. So today we're going to talk about the home building sector as a whole, and we're going to look to see if we can't play for a little bit of a bounce in the short term. However, if we do end up with positions, I'd like to own that position for a long-term hold. So let's explain, and maybe if you don't like this trade, at least you can use it on something else. So the symbol that we're going to look at today is XHB. That is the home building sector, and look at that decline. So a massive decline here, and very consistent decline since interest rates really started steadily creeping higher. It broke down out of this range and has been just nothing but weak ever since then. However, there are now some grumblings of analysts starting to say maybe this is a buy here, maybe it's oversold in the sort of midterm, and so I want to take a look at a trade with you. This is a falling knife. We do not want to catch the falling knife. You know the saying, a falling knife you don't want to try to grab for fear of missing the handle, right? Or getting sliced. So anyways, what we want to do is position ourselves with the best average cost that we can get, and possibly owning shares here if this ends up being a discounted play that we want to do. Now, since it's a $34 stock, it's really not expensive. We could just buy shares. The problem is we'd have to be right from this point, and if it fell another $2 or $3, we may not want to suffer through that pain. We could sell a put in this case, but we may not be able to make enough money to offset our average cost. What if it keeps falling? So what we'd like to do is find a way to say we'd buy it if it fell a little lower, but if it happens to bounce, maybe we'll make a little money or just call it break even and walk away. So I want to talk about a real simple trade. It sounds complicated at first, but it's a real simple trade, and it's just called a ratio spread. And so basically what you're going to do is you're going to do two trades in one. You are going to buy a bearish put spread. So you're going to essentially bet on the stock moving a little bit lower, and then you're going to sell a put lower in hopes of maybe getting some shares, right? Or making a little premium while you wait. So it's two trades, however, we do them together, and because of that, we call it a ratio spread. And so what we're going to look for on this today is to buy a $34 put, which is essentially right where the ETF is trading right now, and then we're going to sell a $33 call. And so that trade right there means we'd like it to fall down to 33 so that we can make our spread there. So we can make $1 minus whatever it would cost. But we don't want to pay for that trade because we may be willing to accept shares. And so because of that, we're actually going to sell one more $33 put. And so we'll buy one $34 put, we will sell two $33 puts, and because we do that, we're actually going to end up with a credit of 18 cents. You can actually see it on the screen down there, just in my example. Let's call it 15 cents to be exact. Now, what happens if the stock goes higher? Let's talk about it. So we're going to end up with one $34 put, and we're going to end up with two $33 puts. Right? So this will be 2, and this will be 1. All right? And so we're going to collect 15 cents for making that trade. If the stock ends up going higher, we're going to make 15 cents. Right? So we really don't want it to go higher. If it does, it's like, okay, no big deal. We got 15 cents. We pay some commissions, and it's not a problem. We actually want the stock to drop here because what's going to happen if the stock ends up falling, we are going to make potentially $1 on our long put spread, right? So the profit potential is actually plus $1 if it falls. And if it only went down to 33 and basically stayed in that area, we could make $1, and that'd pretty much be the end of the game. The extra put that we sold really wouldn't have any effect as long as we didn't go under 33, so we would collect the 15 cents. So if it goes to 33, we could make as much as $1.15. If it goes under 33, we're going to end up making the dollar from this spread here. We're going to make the 15 cents, but we're also going to own shares at the $33 strike price. So you go, okay, well, maybe that's not so bad. If you saw the charts, if you could buy at 33, maybe there's a decent little bounce there. So we've got $1.15 that we would get to keep in premium that we made, and we would own the shares at 33. However, it would theoretically be $33 minus the $1.15, right? So we'd actually end up owning or having a cost basis of these shares at $31.85, give or take a few cents depending on where you get filled there. So we make $1, that brings us down to 32. We make the 15 cents, that brings us down to 31.85. Now, that's interesting. If the stock goes under 33. So let's go back to the charts real quick and let's take a look. If right now the stock price is 34.20. If we could own it at 31.85, look how far down that is. That's off the charts. So we have room for this to sort of move against us and still be above our break even. So the real trade that we're looking for here is for the stock to be under 33, but not by too much. just a little bit. 32.99 would be great by the time we get to expiration. Now that put ratio spread is being done in the November monthly expiration, and that's hopefully not too confusing, but that's what we're looking for here. And it's a really, really simple way to participate on a falling stock, but have an average cost that's way down here, just in case things fall a little bit more. I hope that helps. I hope it makes you a profit. Test it out on some other stocks if you're not quite sure if you want to buy yet, and we'll talk to you soon.